Chapter 7, as the title infers here, we're going to talk about stock valuation. We'll start off in this first part talking a little bit about equity itself as far as terminology, some basic concepts of ownership, the processes of issuing securities. And then we'll move on in the second part where we'll talk more about the actual valuation process. So what are the key differences between debt and equity? I think said another way, I guess, is what's the difference between lending somebody money and owning a piece of a company? So if you own a piece of the company, you get to say what happens. You have a voice in management. You have a claim to some of the aspects of the company, such as its income and its assets. As long as you're an owner, you're an owner. That could be forever. So it has almost an infinite lifespan. And then, of course, as far as returns, you don't get deductions for giving yourself some money. So there's no deduction to the company for paying its owners a distribution of any sort. And of course, all those things are the opposite when we talk about debt. So again, just to continue on with some of the processes here, some of the concepts that we want to talk about, right? Again, just to remind us, interest is tax deductible and dividends are not to the corporation. So if you get to deduct taxes, that means the actual cost is less. When we get and talk about the cost of capital chapter, where we talk about the actual financing of the company, that'll become a little bit more apparent when we see how the government addresses the debt issue and interest expenses from a tax perspective. So what happens though when companies get in trouble? What happens when they, in this case, what happens if they go bankrupt? Well, according to the SEC, right? They set a guideline of who gets paid when. Of course, creditors get paid before equity holders. So the secured creditors, those that have assets or debt that is collateralized, they get paid first. The next people in line are the unsecured creditors. And then if there's anything left over, it goes to the equity holders. That's why we frequently refer to equity holders as residual owners. They only get something if there's something left over. And of course, that's obviously at the top of the next slide, right? So they're only really assured of one thing. They can't lose any more than what they've invested in the company. If they get something back, they get something back. That is obviously why common stock and equity investments are seen as being riskier than debt investments. Debt has a contract that identifies exactly what must be paid, but equity holders don't have such a contract. The common stock of a company can be privately owned, can be closely owned. That is, it can just have maybe 3 or 4 investors, right? Maybe a small group. It doesn't, that private investors and the closely owned, they don't have to trade. They don't have to issue stock to the public. So the shares of privately owned companies, right? Obviously they're not traded, right? So that means that often they're going to have to have special rules in place that designate things like how the assets are traded, how the securities are transferred, not traded, how is income distributed to its investors. But large corporations are publicly owned, so their shares trade actively. It's a very liquid market in the brokerage and the dealer industries. So the primary difference in the ownership here is that in a small private company, it's very difficult to trade the securities. It's hard to get rid of them once you have them, because there's no open air market for you to trade and to transfer those assets to other people. The par value of a company is really a meaningless phrase. The only reason we really talk about it here is because you'll hear it mentioned from time to time, and you just have to understand essentially what the definition is. The par value of a stock is how the accountants journalize stock transactions. So that par value is only important in the journalizing of common stock issuances and repurchases. So anytime we talk about stock in general, that par value is something we usually don't mention. But let's think about how the shares are established and created. Right? So when a company is incorporated, they identify how many shares they are willing to or want to issue. So let's say, it's 400 million shares. So then, of course, once they become a corporation, they have to issue the shares. Some of them will be issued and some of them won't be. The issued shares are owned by an investor. So what happens once the shares get into the hands of an investor? Well, people, institutions, can own the stock. People can have the stock. But from time to time, corporations will repurchase stock from investors. So this is stock that at one time was owned by an investor, and the corporation has bought it back. So now it's in the hands, if you will, or control of the corporation. So, why is all of this of importance? The outstanding shares are the only shares that vote. They're the only shares that receive dividends. They're the shares that are counted when we talk about earnings per share. Treasury stock doesn't receive dividends. It's not included in the earnings per share calculation. So it is just basically an identification of ownership that's been bought back by the company. Why might companies want to buy back stock? Well, there's lots of reasons for that, and I don't really want to get into a lot of the detail right now, but certainly companies need stock to buy other companies. A corporation may have stock that they buy back so they can give them out as stock options to employees as a benefit. So there's lots of reasons why companies buy back. And we'll talk about this when we get to later chapters. When a company wants to issue stock, right, we have to kind of understand, well, what is the situation of the company, right? If this is a company that's already in existence, let's say P&G, for instance, and P&G wants to issue more stock. Well, each stock has what's referred to as a preemptive right. So the company has to tell the current shareholders that they're going to issue new stock and give them the right to buy their ownership in the company. What this does is it protects them from dilution. In other words, we don't want to see the company, the owners of the company, lose control because a corporation issues more shares. Sometimes owners may want to do this because they're worried about losing their jobs. They're worried about a vote that's coming up. So they issue more shares, so now there's more people to vote. And if they buy the shares, they may ultimately end up with some control in the company. But dilution occurs when there is more shares. If you kind of think about the ownership of a company as a pie, right? How many pieces of pie are there? Well, if we issue more shares, the pie didn't get bigger, but now there are more shares. Who owns those shares? That's the question. Again, we'll talk about this later on when we get to the next when we get to the next topic at the end, where we talk about actual financing. And the preemptive right and how these current shareholders get these is through something called a right. So again, they're essentially a piece of paper that says that you can buy these new issues at a certain price within a certain period of time. It's a very short period of time. You may only have maybe 2, 3, 4 days, maybe as long as a week or two to make your decision. But you have to decide what to do. You can exercise these, that is, you can give them the money that they want and you'll get a new share of stock. But actually these rights have value and you can sell these rights to other people. So this is one of the primary understandings, if you will, that owners have when they invest in common stock of a company. Of course, if you own the common stock, most of the time you have what's referred to as a voting right. You get to vote on things that happen within the company. Now, these aren't day-to-day operations, but they are you want to vote on things like mergers. You want to vote on who's going to be on the board of directors. So there is a process that you go through. Typically, this happens at the annual stockholders meeting. Now, there's something called a proxy statement. And in a proxy statement, you can give your vote to somebody else. Of course, you typically only want to give that to another person that thinks just like you, because once they receive the vote, the right to vote, they get to vote how they want to vote. A proxy battle is when non-management group tries to gain control of the company. They're not happy with the way things are going, so they're going to try to get enough votes together so they can vote and make change inside the company. Now, there's different kinds of stock. Sometimes there's stock that's referred to as super voting shares. They may have more than one vote, if you will, per share. Some companies have non-voting common stock. This frequently happens when families own corporations. It's a family business that is incorporated. A good example of this is Coors, Molson Coors now. The Class A stock is owned by people with the last name of Coors and Molson, and that's the only stock that votes. So the stock that you and I can buy, we have claim to assets, but we don't have any claim to make decisions in the company. That is the right of the family, if you will. We obviously talked about dividends. We know that dividends are at the discretion of the company's board of directors, right? They can make dividend payments in cash, stock, or merchandise. I don't know that this is true, but if you could imagine, Walmart is going to pay a dividend of $1 and you own 1,000 shares, so they offer you the right to go and buy $1,000 worth of merchandise. Common shareholders are not promised, right? It's not a guarantee. The only guarantees we have is on the debt side. So you're not certain that you're going to get a dividend if a dividend is going to be paid at all. Before any dividends can be paid, though, obviously we also have to pay the debt people, but indeed we also have to pay the preferred shareholders as well. So in the hierarchy of owners, of investors, let's put it that way, there's the creditors, followed by the preferred shareholders, and then at the very end are the residual owners, which are the common shareholders. Certainly common stock has an international market. There's lots of ways that you can buy stock internationally, right? Once we get to the chapter where we start talking about risk and portfolios, and hopefully will make a little bit of sense as to why you would want to broaden your ownership internationally. We'll talk about that in a little bit more detail when we get to that risk chapter. But how can you buy stock? Well, you can buy the shares of stock on an American exchange, right? So you can buy Toyota on a United States on the on the New York Stock Exchange. But what if stock doesn't trade there? Well, you can buy the shares on the foreign exchange, right? So you can go and you can buy the companies that are trading off of the Nikkei exchange in Tokyo. But now you got to worry about currency issues. So maybe you do this through multinational companies. Multinational companies, obviously by definition, are international. Now there is some question as to whether or not this is true diversification and truly spreading out across the globe by just using multinational companies. Quite frankly, one of the easiest ways to do this is to buy mutual funds. Most equity mutual funds, unless they designate themselves as being a domestic, a United States stock mutual fund, have an international component. Now, true international funds do not invest in the United States. So a global mutual fund might actually be heavily weighted in the United States. An alternative way to buy internationally, especially international ownership, is through what are called ADRs and ADSs. And essentially what this mechanism is there is a financial institution that buys the stock. And then from that institution, you buy a piece of paper that entitles you to that share. But the bank keeps the share. So what happens is when you buy it, you need US dollars. When that company pays dividends, whether they be yen or euros or whatever, then they pay that to the bank. The bank converts it to dollars and you receive dollars. So again, this is just a way of investing internationally to get a piece of the pie of the global marketplace, if you will. We won't spend a lot of time talking about preferred stock because, quite frankly, most companies don't have preferred stock. Preferred stock is part debt, part stock. It has the benefits of both. It has a fixed dividend that's paid. However, unlike debt, it's not a guaranteed payment. The company doesn't have to pay it. So we could have par value preferred, that is where it has a specified dividend percentage is what's paid, or we could have a no par preferred, where essentially in this case they just tell you what the stated annual dividend is going to be. Financial analysts frequently lump preferred stock with debt to analyze the leverage of the company, because most companies treat preferred stock like it is debt. We talk about quasi debt. It acts a lot like interest. It has a fixed periodic payment, but it has no maturity date. It has a fixed claim on the firm's income. However, there's no. It takes precedence over the common stock. We talked about that earlier. But preferred shareholders have a little bit less risk than common shareholders. So in the scheme of risk things, debt is the less risky, then preferred stock, followed by common stock. And again, preferred shareholders are not true owners. They don't typically have a voting right. However, sometimes there are mechanisms where they can at least get a person on the board of directors that will be acting in their best interest. We mentioned that preferred stock dividends have to be paid before common stock dividends. In a cumulative preferred stock, what that means is any dividend that has not been paid, whether it's the current dividend or a previous dividend, you have to pay all the dividends in preferred stock before you can pay any to common stock. We'll talk a little bit about this in class and maybe make that a little bit clearer. But the alternative is to have non-cumulative preferred, which basically says if the corporation doesn't pay a preferred dividend, then you're just out of luck. That year, they won't pay a common stock dividend, But the next year, we kind of start at zero. And if they want to pay a preferred dividend that year, they can pay it. And then obviously pay the common stock dividend. But in that 1 year, you can't come back and there's no mechanism to recover and recoup the dividend that was missed, if you will. A callable feature is when the corporation has the right to force you to sell back your preferred stock. And there are a lot of callable preferred stocks out there because the corporation wants to treat preferred stock like it is debt so that they can retire it at their will. And this way they can set the price at which they want to buy it back. Now, of course, they always have the option just to go to the marketplace and buy stock back from investors in the marketplace. A conversion feature is when the investor can decide if they want to convert their preferred stock into common stock. So they can increase their equity in the company by making it stronger because now they have more rights. But it's at the option of the investor. So how is stock ultimately issued? How do we get stock? Well, it kind of depends on the company. It depends on where they're at in their history. So in the very beginning, right, for companies to get started, they frequently have to go to some type of an investor that can help them. As a general term, we refer to these companies as venture capitalists, right? They provide their companies or businesses that provide funding for early start businesses. Now, because of their investment, they're going to, and the risk involved of startup businesses, they're going to have relatively higher rates of return, but they're also going to have some strong oversight about the companies. So they're going to take a management role and try to make sure that the company does the things that are necessary for it to be successful. Angel capitalists are individuals that do this. They don't want to really be part of the business, but they obviously do want to help businesses grow. They also want the kinds of returns that come from these high-risk investments. So when a company wants to go public, right, they've been around for a while, now they want to issue stock so that you and I can buy it, what this is referred to as an initial public offering. They can do that through a public offering itself. They can do that if they already exist. This is where they can sell new shares to existing shareholders. And a private placement is when they find somebody that has some extra cash, usually an investor or an institution that has a lot of money, and they try to get them to buy the shares without going through the process of the public offering itself. So the IPO is usually made by small, fast-growing companies, right? There's a lot of those have happened very recently. We have to go through current shareholders sometimes to make sure that we can hire an investment bank that's going to underwrite the offering. So what does underwrite mean? Underwriting means that the investment banking company takes the risk of issuing the stock. So what is it that they do? Right? What is the process that they do? Well, they help by filing a registration statement. When they first start out, there's something referred to as a prospectus is provided to potential investors so that they can understand what the company is all about, talks about the issue, the issuer, management, their financial position, etc. In fact, these typically are referred to as being a red herring. A red herring is distributed before we actually have gone through the registration process. So this is kind of a, before the sales can actually start, we want people to start investigating so that when the time comes for the stock to be issued, it's now time to issue and we can get this thing rolling. The investment banker I talked about is the person that helps with the underwriting. That's the person that tries to help us distribute shares. That is really their process. Corporations don't have people on staff that are in tune with the marketplaces. It's because companies just don't do this that often. So an investment banker provides advice about pricing, advice about the securities that can be offered, but they also, investment bankers, help with the distribution of shares. Now, there's a lot of risk involved. So what happens is they're going to ask other bankers, other investment bankers, to help them distribute the shares. So instead of them having to get rid of $400 million on their own, maybe they incorporate 10 others along with themselves. They have 10 of them, and each one of them is going to get rid of 40 million. It's a little easier to get rid of 40 million shares than it is to get rid of 400 million. So again, this syndicate or this selling group is put together in order to spread out the risk of the investment bankers. And of course, you can kind of see this. We have, here's the issuing institution. We have an underwriting syndicate, if you will, a bunch of investment bankers. And then each one of these investment bankers has a group of people, typically brokerage houses, that are ultimately going to contact investors so that they can ultimately purchase the securities. So that's the first part of Chapter 7. It's a pretty long chapter, but it is really the essence of understanding the ownership in a corporation.